When investing for the future, it's important to invest in the right mix of asset classes to minimise volatility and help protect your investment from risk. In this video, I'll talk you through what an asset class is, the types of asset classes available, and what asset allocation you need to consider for your wealth. So firstly, what is an asset class? An asset class is a group of securities or investments that share similar characteristics and behave in a similar way to each other. There's a long-running debate about exactly how many asset classes there are, but in this video I'm going to look at the 5 traditional asset classes, plus one extra for the investments that don't fall into these main categories. These 5 asset classes are cash, fixed interest investments or bonds, property, shares, and commodities. Now let's take a look at what each of these 5 asset classes are, which investments they include, and the advantages and disadvantages of each one. First up, cash. With cash, there is no capital risk, but it is susceptible to inflation risk. It's backed by the government and assets are easily accessible, but it provides limited opportunity for growth. Typical cash investments include physical currency, bank accounts, savings accounts, and cash ISAs, and it has a low risk profile. Cash is the asset class that you're probably most familiar with because we use it on a daily basis to pay for goods and services. The asset class for cash includes physical currency, the balances of savings and current accounts, cash ISAs, premium bonds, and money market funds. The main advantage of cash as an asset is that it's very safe. It's the only asset class that doesn't pose capital risk, as you'll always get back what you put in. Cash is also backed by the government, meaning they'll protect your bank account or cash ISA up to £85,000 per institution through the Financial Services Compensation Scheme, the FSCS, should a bank or building society go bust. Another benefit of cash is that it's typically liquid and can be accessed quickly and easily at any time, though you can also lock cash away in fixed-term deposit accounts for slightly higher returns. The main disadvantage of cash assets is the danger posed by inflation risk. This happens when your savings don't gain enough interest to beat the rising cost of living. This means that the value of your money is effectively eroded, even though your capital is not at risk. If you're looking to grow your savings quickly and you have too much invested in cash assets, your wealth won't increase in value very quickly. Next up, fixed interest investments. With fixed interest investments, you know exactly how much you'll earn, and these also have the potential to provide you with a regular income. But there is a risk of the issuer defaulting. This asset class typically provides a lower rate of return than shares and are less risky than shares. They are susceptible to interest rate risk, but are good to include for a diverse portfolio. Typical investments include bonds, debentures, and gilt-edged bonds, and this asset class also has a low risk profile. Fixed interest investments, sometimes known as fixed rate securities, involve investors loaning their money to a company or government in exchange for a security in the form of a bond or a similar product that pays an agreed rate of interest. This rate remains the same throughout the duration of the investment, and when it matures, you'll also be paid back the original amount that you put in. The key advantage of a fixed interest investment is that you know exactly how much you stand to earn over the term, which makes it easier for financial planning. Provided the organisation that issued the security doesn't default, you can work out exactly when and how much you can expect to receive on a certain date. Because they pay out interest at certain intervals, they can be a good choice if you're looking for an investment that provides a guaranteed regular income. An additional advantage is that bondholders are given preference over shareholders if a company goes bust. This means that purchasing a fixed interest security is less risky than investing in a company's equity. However, it's worth remembering that bondholders are outranked by creditors, so there's never a complete guarantee that you'll get your money back should the organisation fail. Fixed interest securities tend to be impacted by market events in a different way to equities. So if stocks take a hit, it may be that bonds experience stronger returns. This makes them an excellent choice if you're looking to build a diverse portfolio that has a good balance to it. But though they're fairly low risk, fixed interest investments still aren't a sure thing. Even though they provide regular interest that is contractually obliged to be paid, if the organisation defaults, your investment is at risk. Bonds are traded on the stock market, and they can lose their value if the company runs into trouble, so you're not guaranteed to get all of your money back. Fixed rate investments are also subject to interest rate risk. When interest rates go up, they remain static, so they become less valuable. But the opposite is also true, and they can hold more value if interest rates decrease while you're holding them. Now let's look at property. Property as an asset class has a good track record of beating inflation, but it requires long-term investments. It can provide an extra stream of income if you buy to let, and is an effective way of diversifying your portfolio, but funds can get tied up in slow sales. Typical investments include buying your own home or a holiday home and investing in buy to let, and it has a medium risk profile. Investing in property can take many forms, like buying your own home or getting involved in commercial property like offices, warehouses and retail space. There are also opportunities to invest in both small and large scale projects, ranging from a single buy to let concepts, joining an investment fund that owns large-scale commercial sites. Property is an asset class that has a good track record of beating inflation. It can be a good long-term investment if you're looking to take advantage of an improving housing market, while renting out your buildings can give you another regular stream of income that you could channel into a savings account or invest in other assets. The main disadvantage of property is that it's a long-term investment that needs time to produce the best returns. Taking on a mortgage or even buying outright is also a major financial commitment and requires a large initial outlay, so it needs to be an investment that you're going to be comfortable with for the next few years. There's also a significant risk of over-concentration, in other words, a lack of diversification due to holding only 1 or 2 properties in a certain area. It's also easy to get your money tied up in property as the market moves slowly and quick sales are not always possible, so you may be forced to accept a price lower than you paid if you need to liquidate your investment quickly. Now let's talk about shares. Shares provide the potential for higher returns and are good at beating inflation, but they're affected by factors beyond your control. They also require a long time commitment, and there is the possibility of regular dividends being paid. Shares are typically acquired by purchasing equity in a company listed on the stock exchange. They have a medium to high risk profile. When you buy shares, also known as equity, you are buying a small portion of ownership in a company. Each share represents a unit of ownership, so the company value is divided by the number of shares to give the share price. They are traded on the stock market, where the daily value of each company's shares are listed. There are a number of factors that can cause the value of a business to increase and boost the value of each share, such as if the company does well or undergoes a merger. On the other hand, if the company does badly, the shareholders can face a drop in the worth of their shares. The main advantage of investing in shares is their potential to deliver better profit than lower risk assets, such as cash and bonds. This makes them a good choice if you're looking to beat inflation. Equities can provide better long-term returns, with short-term volatility evening out and having less impact if you invest for 10 or more years. In addition, some companies will pay dividends to their shareholders, providing a regular income stream. On the flip side, the price of shares is affected by many factors, many of which are beyond the control of the company. When the prices rise and fall, it may be the case that your shares are worth less than you paid for them, especially during times of economic uncertainty. However, the market could well recover and you could turn a profit once again. To get the best out of any equity investment, you need to be in it for the long haul. So if you need your funds to be readily accessible, it's worth considering other asset classes. And lastly, commodities. Commodities have the potential for quick, sizable gains and are also an effective way to beat inflation. However, markets are very volatile and they are less liquid than other assets. They're also affected by factors beyond your control. Typical investments include oil, coffee, and gold, and commodities have a high risk profile. Commodities are simply raw materials that are bought and sold on global markets where supply and demand, as well as other global issues, dictate the price. They can include fuels like oil and gas, precious metals like platinum, gold, and silver, agricultural products like wheat, coffee, and dairy products, industrial metals like copper, iron, and steel, as well as many other things. A lot like shares, commodity markets regularly rise and fall, but they tend to be much more volatile. While the market price of commodities fluctuates a lot more than other assets, a smart investor could make a much bigger income in a short space of time, though this carries higher risk. Adding commodities to your portfolio is a good way to secure your wealth against inflation. While stocks and bonds will perform poorly against high inflation, commodities perform well thanks to the increase in price of goods and services. But because the commodity market is incredibly volatile, investment in this area carries a much higher level of risk than other asset classes. Commodities also offer much less liquidity. It's more difficult to buy and sell your assets quickly without affecting the price. This, combined with the fact that the commodities are at the mercy of both nature and geopolitics, creates a market that can quickly change direction, for better or for worse. And now for the other investments. Aside from the main 5 asset classes, there are other areas that you can invest in to really diversify your portfolio, though it's worth remembering that each will have its own level of risk and reward. These typically include art and antiques, wine, watches, and peer-to-peer lending, and can be low to high risk depending on the investment. Although these fall outside of the traditional asset classes, many alternative types have been traded in for a long time. Art, antiques, stamps, watches, wine, and jewellery are all examples of valuables that have been traded for centuries. On the other hand, there are lots of new asset classes that have only emerged in the past few years, such as cryptocurrencies and peer-to-peer lending, demonstrating just how diverse this investment marketplace can be. Many people feel that newer asset classes are riskier than those that are more established, but this isn't always the case. For example, peer-to-peer lending is a fairly new type of asset that can have a relatively low risk profile, depending on the types of people or companies you're lending your money to. Investors lend their money directly to borrowers without the need for a bank boosting the rate of return. While this means that cover from the Financial Services Compensation Scheme, the FSCS, is not provided, the best peer-to-peer platforms guard against potential loss with contingency funds and backup service agreements. The result can be a good investment opportunity that can offer better and less volatile rates than many ISAs, bonds and savings accounts by taking on a little more risk. To create the best, most diversified investment portfolio, you should employ a blend of all of these asset classes.